Nobody should ever be surprised by a will.
And if you think probate's bad, try to do a multiple state probate. So if you have properties in different states and you don't have a revocable living trust, you just tell everyone in your family that you hate them.
Donating cash is generally the worst thing you can donate to a charity, but by far entrepreneurs donate cash more than anything else because it's the simplest.
Think about the value of your business. If your business is worth $100 million, you're going to have a big tax problem, and the IRS wants to get paid in cash in 9 months.
Ensuring you have concrete family governance that is complementary to all of these estate documents is important. But if you don't have the family governance, then all of those documents are really just not worth a whole lot. All right, Jim, we're back here. Chapter 4, Billionaire Wealth Strategies for Entrepreneurs. We're going to talk about transferring your wealth and values.
Yeah, one thing I'd start with on this, because this is so often missed, is over the years I remember sitting down with a lot of entrepreneurs, and I'd look at their balance sheet with all their investments, all their assets, all their real estate, and all their stuff, toys, money, jewelry, all that kind of stuff. And I would ask them, I would say, other than your money and your stuff that we just talked about, what would you like to pass on to your kids and your grandkids? And then they start telling me about their values and their beliefs and all these incredible things. And when they finish, I asked a simple question, which is, if you could only leave one thing to your kids, grandkids, great-grandkids, your money and your stuff or what you just described to me, what would you leave? And you know what they told me every time? All those values and all those beliefs. Because they said, if my kids, grandkids, great-grandkids have those values and beliefs, they will be okay. They'll make their own money. They'll be successful. But if they have my money and my stuff and they don't have those things, they're going to squander the money and the stuff and they're going to end up nobodies. And I've always thought about that. And that's one thing that gets missed a lot when people talk about transferring to the next generation or the generation after that is, yes, transferring your money and your stuff. That's important. But even more important possibly is passing on your values and your beliefs.
Yeah. Well, the stories are so important. And when you were telling me, when you're saying that story, what it reminds me of is something that we're actually did within my family is we used a product called Memento. It was on Shark Tank. And what you do is you record stories. So we had my dad do this, recording stories of his throughout his entire life, which really shows the values, his beliefs, his upbringing, how he was able to create and build what he built. And then what it does is it uses AI to then consolidate that and to create a hard copy book. And so then there's a book that comes with it. And then you have a QR code. You scan the QR code and you get the voice of him actually going through the story.
Wow.
So the idea is that for future generations, they'll be able to read the stories that are curated by AI based off of the transcripts, but they can always scan the QR code and actually hear the voice. Wow. And so that was a way that it was important for us to memorialize the stories, which I think is very important for us as individuals to understand it as a family unit. Where are we from? Who and how was all of this created? And where are we going?
Yeah, that's so good. I was just remembering, I have so many stories from my parents, and of course they grew up very poor in the Great Depression. When they first got married, they were living in the projects in Cleveland, so very poor. They would talk about how when it rained, the rats would come up from the basement. It's like really poor. And my mom said one thing that they did was they would take a few dollars and they would put it away in a drawer somewhere. And when things got really bad, life was really tough, they'd take that few dollars and they'd go get a slice of pizza and a beer. And that was their, we're going to be okay type thing. And as I think about stories like that, it makes me realize, like, wow, how fortunate I am in my life that I don't have to save a few dollars so I can go get a slice of pizza and a beer. And even, I was just thinking about this not long ago, Mimi had a problem with her car, and I didn't have any stress about, like, how much is it going to cost to fix the car. And I remember when I was a teacher, if I heard a funny sound in the car, I'd immediately have this anxiety and this panic, like, what if this costs more than $1,000? Where am I going to get the money? And those are the kind of stories that can teach kids and grandkids the meaning of a dollar, or that value of being appreciative and grateful for what you have.
Yeah, it puts it all into perspective. And it's sometimes good to be reminded of that and how far we've come and our families have come. Well, let's talk through what we're going to do here is go through basic estate planning documents. That's so important because those are the mechanisms, the documents whereby you can transfer on not only your money and your things, but also your values and your beliefs. And then we'll talk through why, for most entrepreneurs, estate tax planning is so important because of the estate taxes. And then we'll get into family governance and then eventually some charitable planning.
Great.
So let's start off with some basic estate docs. Now, oftentimes when we're talking entrepreneurs, they often don't have a basic estate plan put in place. But when we say basic estate plan, what are the documents that we're generally referring to?
Yeah, well, typically they're going to need a last will and testament. They're going to need a living will. They're going to need powers of attorney, both for financial and healthcare, and then, guardian designations and a living trust or a revocable living trust. Those would be kind of the big building blocks of everything that you would need. And if we just start real quick and run through these, a will is usually, for most entrepreneurs, if they have a living trust, which you should probably have if you have any assets at all. But if you have a living trust, it's usually a pour-over will. And that just tells a judge, because a will is synonymous with probate. If you have a will, the will goes through probate. That's why you get a trust, is to avoid probate, among other reasons. So you'd have a pour-over will, which would just tell the probate judge, hey, if I forgot to put something in the trust, I meant to put it in the trust, would you pour it over into the trust, right? If you title things correctly, which I would hope entrepreneurs would, then you don't have to worry about that. But the most important thing other than that for the will is designation of your guardians for who's going to take care of your kids. And I would imagine you've got your people listed out for who's going to take care of your kids if something, God forbid, happened to you. A lot of people don't do that. And then it may be the worst person in the family who steps forward that would get the responsibility from a judge to raise your children. So you have to have that in that basic document that's a will.
Yeah, well said. And let's move on now to the powers of attorney.
Yeah.
So I think the powers of attorney are two different documents. You're going to have the durable or financial power of attorney, and then you're going to have the healthcare power of attorney. And the way that I like to describe the durable or the financial power of attorney is going to be any assets that are not governed or owned by the trust. If you were incapacitated, who can step in and manage those assets? That could be a business. That could also just mean someone signing on your behalf if you want to close or sell or buy some real estate. But again, if it's something that's owned by the trust, then the successor trustee is going to be able to step into the shoes there. But for anything that is not titled appropriately, or if you don't have a trust, that's where the durable or financial power of attorney is going to come into play. And one of the key decisions you need to make when you're putting a power of attorney in place is, do I want this to be durable or do I want it to be springing? And there's some pros and cons there. And I'm curious to get your thoughts on that, on what you think is best for most entrepreneurs.
Usually when you have a stable marriage, you would want your spouse to have the durable power of attorney. So Mimi has my durable power of attorney. And I guess just to step back a second to define those terms, durable means it's already active. So if Mimi wants to use the power of attorney to sign for something, she can do that. A springing would mean there has to be some sort of triggering event. So that could be two doctors say, I can't make my own decisions. Now that springs into action. So with a spouse, usually durable. But if you were a single person and you had kids, maybe you want it to be springing if you're not sure that you want to make sure your kids don't just start signing stuff in your name using the power of attorney without your permission. So you have to make that decision based on your situation. But those are the two, springing and durable.
Yep, well said. And then similarly, that's the financial power of attorney. Then you're also going to have the healthcare power of attorney, which that's just going to essentially be a very similar document, but it's the whole situation of if you're incapacitated, you're at the hospital, who can make healthcare decisions for you, who has access to your documents via HIPAA, and just making sure that you get the right type of care and the quality of care that you wanted to get.
What I noticed too, a lot of these documents, entrepreneurs get them boilerplate and they don't read them. They don't even know what's in there. So for example, if you want, when your healthcare power of attorney springs into effect, if you want a certain doctor to be involved, who you know very well, you want to list out that doctor, call this doctor, I want this doctor involved. You need to list things out and think these things through instead of just putting them in there. Also, a mental health care power of attorney. Usually this is a separate section or a separate document, but some states have instituted that if you don't have a mental health care power of attorney, or it's not embedded in your power of attorney for health care, you can't admit someone into a mental health care facility. So here's a scenario. You've got husband and wife, and husband gets dementia, and it's getting worse and worse and worse. And finally, there comes a night when he takes out the car, and she flips out and she goes, I can't do this anymore. I can't stay up all night. So she takes him. She finds a good place. She takes him down there to admit him, and they say, well, do you have a mental health care power of attorney? Well, I have a healthcare power of attorney, but if without that provision in certain areas or with certain facilities, they will say you can't admit him without that. Well, she can't get his permission to do anything now because he already has dementia or Alzheimer's. So then she has to go to a court and then actually get control over him to make that admission. And that could take months while she's trying to figure out how to take care of her husband. Those kinds of things can happen. So you want to make sure you're really think through and read through these documents. No one likes to read these documents, but read through these documents, see what's in there, and then think about how you can protect yourself.
Yeah, well, whenever we are training new associates and new advisors, it's so important that we understand these documents in detail, because the joke I always make, which really it's not a joke, it's true, is whenever I go and help facilitate clients signing these documents, they always are like, well, what should I do? What should I sign? They because they don't understand, they don't read the documents. And to your point, they're then kind of looking at you of like, well, what do you think we should do here?
Right.
And so that's where that just is living proof of what you said, that most people, even if they have these documents, have no idea what they're actually saying.
Yeah. And then be able, and that's again, a role that we serve, is going through those documents and saying, okay, here's the springing event for your power of attorney. Do you like this? Should we change this? Here's the description of how your pain is going to be managed in your healthcare power of attorney. Here is who's going to be taking care of your kids. Like all the things that you need to know throughout these documents that usually people just go, tell me where to sign. And then the time they read those, just like their life insurance or their property and casualty policies, right? No one reads their homeowner's insurance until someone falls and gets hurt in their backyard. And then they read through and find out what they have. And that's usually too late.
Yep. All right, let's dovetail that into the living will. While we're talking about some of the healthcare stuff, the living will is going to be the document that's really going to prescribe quality of life, termination of life, organ donation.
Call it the pull the plug provision.
Yeah, pull the plug provision. And we have seen a lot of very creative and interesting living will provisions with our entrepreneurs. But that's, I think, very important. And also, like, do you want the care at your home? Do you want care, at a facility? I think that's very important. It's kind of a sad document to be thinking through of yourself in that state. But I think it's also one of the most important documents because it's kind of in your final days, or potentially your final days. How do you want to be living your life?
I agree. And you know what happens a lot as far as organ donation? A lot of times people just don't think about it. And if you don't put that into your documents, no one's going to harvest your organs unless you put that in the documents that you want that to be done. And often when someone's just lost a loved one, they're too freaked out to make a decision like that. So that's a decision you would make for yourself. I'm a big proponent. You have to make your own decision, but I'm a big proponent. I do not believe that where I go after here, I require my liver and my heart and my kidneys. And I also have heard entrepreneurs say, well, I'm afraid that I might be fine and that they're going to harvest my organs. And usually we see the opposite, where hospitals are trying to keep people alive and do all these things, even if that person didn't want it. So that's the other reason for the living will, is not so that they keep you alive longer than you would want, and then also create all these medical bills that are not necessary for your family.
Yep. All right. And then let's go into the trust. So you got the living trust or the revocable trust. I think it's important to clear up a common misconception, which is that trust, having a living will or revocable trust, creates creditor protection. And that is not true. It is purely there to help you avoid probate. So to your point, when or if you pass away, all of the assets skirt around probate, so it's not public, it's all private. And it also allows you to avoid avoid estate taxation, which we'll talk about. And then the third thing I'd say is control from the grave, as I often say, is that you can very narrowly control and define who gets your money, when, what are the provisions, the language that the trustee needs to carry out.
In addition, it can help you preserve your exemption for a married couple. So you got $15 million each, and it can help you preserve the one who passed away. If you don't have a trust, you could squander that. So it's one way to protect that. In addition, if you have a married couple, when one person dies, you have the option of having that be a creditor protected trust. So there is that part. And then also, if you have property in multiple states, a trust will eliminate the need for a multiple state probate. And if you think probate's bad, try to do a multiple state probate. So if you have properties in different states and you don't have a revocable living trust, you just tell everyone in your family that you hate them. Next time you get together, just, I hate you. That's why I've done this way. Those are also some reasons to have a revocable living trust. And it's the best for successorship. So in other words, if you have a power of attorney for finance, usually those go only for so long, and eventually the institutions will stop accepting it. But a successor trustee could be the successor trustee for decades. Someone could be in a nursing home for 20 years. You could still be that successor trustee managing things for that person for 20 years. You can't do that with a financial power of attorney.
Yeah, no, well said. And I think the big gap we see with these trusts is that even if an entrepreneur has a trust set up, it needs to be funded. And what that means is you need to make sure your assets are actually owned in the name of the trust. Now, that's not required for like a 401k, an IRA. Those you just got to get the beneficiaries on, because those are going to be passed outside of probate. But your business, your real estate, your brokerage accounts, your crypto, any private equity, any of those types of assets, you need to make sure are actually owned by the trust. Otherwise, the trust is just a piece of paper. So it needs to be filled up with all of the assets.
Yeah, the way it was described to me probably 30 years ago by an attorney is trust is like a box. Everything you put in that box is governed by that box. If you don't put something in the box, it's not governed by the box. And what we mean is by titling things into the name of the trust. Also, if you have 401ks, IRAs, and you're naming beneficiaries who are minors or people you don't have responsibility, you can use the trust as the beneficiary, but you want to make sure there's specialized language in the trust to handle IRAs and 401ks, and often people overlook that.
Yep. All right, so that's the basic estate docs. And then let's dovetail that into the estate docs, or estate taxes, I should say. And so what's interesting is that here in the United States, we all pay taxes, income taxes on everything that we make and that we have. And then when we sell assets that are appreciated, we pay capital gain taxes. But also something that we all get hit with, or some people get hit with, I should say, is if you have a net worth over $15 million per person, $30 million as a married couple, you then have to pay estate taxes. And that estate taxes is 40% above that $15 million if single, or $30 million if married. And it's on top of that, there could be state-specific estate taxes. So oftentimes these are called death taxes, because essentially it's the government coming back after money they've already taxed you on and coming back for another bite. But paying estate taxes is optional, because you can do appropriate planning through some advanced trust structures that we're going to talk about to mitigate or completely avoid the estate taxes.
Yeah, very true. And if you think about it, if you're 10 million over your exemption, 40% of 10 million is $4 million bucks. I mean, it racks up quickly. And then it also depends, because remember, when someone passes away, they get a stepped up basis on capital assets. So that's a big tax advantage. But the value of those things, or think about the value of your business. If your business is worth $100 million, you're going to have a big tax problem. And the IRS wants to get paid in cash in 9 months. So that's a huge challenge, because if you had to sell your business, if we had to sell our business in 9 months and everyone knew we had to sell our business in 9 months, what would they do to the price they would offer us, right? They would give us a crappy price because they know we have to sell. So you don't want to put your family in that situation either.
Yep. And so one of the most common ways that you can get around or mitigate these estate taxes is through what's called a dynastic trust, or dynasty trust. And the best example here is what Rockefeller did. He created irrevocable trusts, and then those irrevocable trusts held all of the different business interests and all of the different investments and assets. Then each generation was a beneficiary of this trust. But as they say, you own nothing, control everything. And that's the key to an irrevocable trust, because we talked about filling up the revocable trust as a bucket. The irrevocable trust is a similar bucket, but that bucket is never going to be subject to estate taxes. So the whole idea is let the money grow and compound within that bucket. It'll pass through generation to generation without ever paying estate taxes, but then future generations can access the money and pull money out. But again, you avoid the estate taxes.
And this takes some foresight and planning ahead. And if I think about Sam Walton, the founder of Walmart, I think it was in the 1950s, he gave away 80% of Walmart, 20% to each of the 4 kids. He kept 20%. And that move alone, after he died, his 4 kids were in the top 10 richest people in the world for many years. Mm-hmm. So think about that. Split it to the 4 remaining, to the 4 survivors, and each one of them is in the top 10 richest people in the world. That was because he had foresight to moving some of the assets, or actually in his case, a majority of the assets, out of the estate long before he passed.
Yep, and specifically, Walton used grantor retained annuity trust, or GRATs, and essentially that vehicle allows you to put assets into an irrevocable trust, and there's a certain IRS benchmark interest rate, and if the assets, which in this case was Walmart stock, grow at a rate that's higher than the IRS benchmark rate, all of that appreciation is removed from your taxable estate. So as a simple example, which is overly simplified, let's say it's $100 million of assets that you put in there, and the IRS benchmark rate gets rate is 5%. Well, if the Walmart stock goes up by 15%, 15 minus 5, that's 10% excess on $100 million. That's $10 million that goes into that grant to retain annuity trust free of estate taxes. And then you just keep rinsing and rolling these. It's called rolling grats. You keep rolling that money over and over and over again. That's essentially how you saw Walton do this without paying any estate taxes.
Yeah, very smart. Most definitely.
So within the estate taxes, we also, this is where really those 4-letter acronyms come into play. We see IDGT, IDGT. We see SLATs, Spousal Lifetime Access Trust. We see BDITs, if you want to sell the business. We see DAPs, Domestic Asset Protection Trust. So this is where it gets really hairy, and there's a lot of different options here. But what's important that you mentioned is having the foresight, because if you can move a business interest or some sort of appreciating asset into an irrevocable trust out of your taxable estate, it still allows, again, you or your children or other heirs to have access to that money, but you don't own it anymore. And I think a great example here is that we've got a client who recently had a transaction, $70 million. So if you look at it on the surface, ignoring any other assets that they had, if they passed away, there's a $30 million exemption because he's married. So $70 million, let's just say net worth, minus $30 million exemption, $40 million is subject to estate taxes. At 40%, that's $16 million that had to get paid from his estate. But what we did is we got the business valued several years ago for about $6 million. So what we did is we used $6 million out of his $15 million of his exemption amount and put the business into the irrevocable trust. So now all of that growth is outside of his taxable estate and in the irrevocable trust. So he didn't even technically own the bulk of his business. 80% of the business was owned by these irrevocable trusts. But then when he sells it, now all of this growth is outside of the taxable estate, and now we're creating that dynastic trust structure for him.
Yeah, so smart. And you know what? This is stuff that you actually need a lot of guidance. And one thing I worry about sometimes with very smart attorneys, they have all these tools, and sometimes they make it too complicated. So sometimes we see entrepreneurs that don't even have a will, right? They haven't done anything. And then we see others that create this maze of complicated trusts and entities that makes sense to the attorney, but is very hard to manage and to keep up with and very expensive for the long run. So you want to find a sweet spot in accomplishing what you want to accomplish, doing it long before it becomes obvious, and yet not overcomplicating your life with a structure that you don't need.
Yeah. Well, paying estate taxes is optional. One thing that is not optional is family governance, especially if you as an entrepreneur want to pass down your business to future generations. But even if you're going to pass down a substantial amount of wealth, ensuring you have concrete family governance that is complementary to all of these estate documents is important, because the estate documents are just going to be hundreds and hundreds of pages of legal documents that's going to outline the rules, who's got to do what, who's getting money, etc. But if you don't have the family governance, then all of those documents are really just not worth a whole lot, not worth the paper that they're written on. So when it comes to family governance, I know this is a topic that is close to my heart because I feel it personally. But what are some of the biggest things that you've seen, Jim, that are important in terms of raising your kids or future generations or your heirs to be good stewards of capital?
One of the first things is it's critical for the family to get together in person on a regular basis. And that doesn't mean once every 5 years, at least once a year for a family retreat, at least touching base, throughout the year. Because if you don't create almost like that family connection, those relationships, then you start to get problems. Just like I said earlier, things drift when you don't pay attention to them. So that's critical. So you want to think about an annual gathering. You want to think about how you're going to involve everybody and have everyone feel that they're valued and that they have a voice to be contributed. Now, that doesn't mean everyone has a voting voice, but it means that you want to make sure that your kids and their spouses feel a sense of community with the family. And then you also want to have rules and how the family is going to function. So that could be everything from how does money get doled out? Because often entrepreneurs want to create a family bank. So they say, hey, if my grandchild wants to buy their first house, I want to help them do that and give them a loan from the family bank. Or my grandchild wants to start a business, I want to be able to help with that. But how does that work? What kind of house? How much are you going to fund from the family business? What's the interest rate going to be like? If you're going to start a business, how is that going to be evaluated? Is there marketing and a business plan and all those types of things? So all those things have to be figured out Because when money gets given out without any rules, then you create hurt feelings, upset family members, or ones that just feel entitled and want to get their money out. You also need something about giving. I think every family that's wealthy, if you don't have a charitable aspect to that family, there's not going to be enough that ties you together. Because what happens with money is people start to see it as something where you get to buy cool stuff, you get to go to cool places, you get to have expensive wine or whatever it might be. And that misses the point of money being something that you can do for others. Because if you have selfish family members, you're going to create a problem in that family. If you have giving family members, then they're going to be much more generous, not just with people outside the family, but with people inside the family. Those are a few things off the top of my head.
Yeah, I think those are all great points. And when I think of family governance, I think it all starts with Warren Buffett once said that nobody should ever be surprised by a will. And I think that's the very first step, which is a hard step. It's easier said than done, especially if you're very wealthy. And there's a lot of nuance around how to broach this conversation, this topic. But you need to make sure that your kids or your heirs understand who is getting what and why. And those conversations need to be had sooner rather than later. And that's one of the first conversations that I think needs to be had, is just understanding the flow chart of the estate plan, of the distribution. And then I think from there, you then dovetail, you go next into, okay, what do we actually have? What does our family, balance sheet or business balance sheet look like, or the P&L, depending on what your goals are and how much you're trying to disclose. And then to your point, if you do this every 6 months, twice a year, having family retreats, make it fun. It's just, if you do this for 10 years, 20 years, you just build up the acumen, you need to build up the muscle. And then, when someone were to pass away or the next generation, you kind of have that playbook set up. And this is something that we do within my family right now, which I think is great, is my dad passed on his ownership of his business to really me and my three sisters. We each own 25%, and it's all baked into the operating agreement that it has to be passed down, per blood. And so that's baked into everything. And then every 6 months we get together. It's an excuse to get the family together, write it off the business, go hang out at a resort, get the kids together. And then we have a meeting. We talk through, hey, how has the performance been with the real estate, the land, the farmland? And then we talk through, what does the operating agreement say? What does the estate plan say? And so then that way, then when my kids and the third generation is old enough, we now have the template, and now they're going to have a seat at the table. And it's been awesome seeing this, that we're now at 17 years. So we've been doing this for 17 years.
Wow.
And it's like there's no friction, there's no surprises. Everyone is very clear, but it doesn't happen overnight, right? That's 17 years of biannual meetings.
Yeah. Another thing I've seen families do that's very powerful is they start when their kids are pretty young. And it can be, even if you're not at this level where you have more than 15 million as an entrepreneur, you start with this generosity giving thing. And so once a year, when the kids are old enough, each kid brings one charity that they want to fund that year. And then they present to the family why they think that charity should get the money. And you can start out with $1,000, whatever it is. And then each of the kids gives their little presentation, and then you decide as a family where the money's going to go for that year. And you could even do it like different prizes or different levels, or every charity gets something, but the one gets the big prize. And that forces kids to think about, how can I give to others? What is a cause that breaks my heart that I want to do something for? And that can be a great way to unite the family in a kind of a giving experience that can scale over time. Maybe it becomes a day where every year you have to give $1 million away, and you have the family get together and the kids and grandkids and people present, and you decide who gets the $1 million that year. That's a way that I've seen that you create connection with the family, is doing that and having each person have to come up with their own charity that they want to fund that year, and then why should their charity get the money.
Yeah, I love it. Family governance. So yes, very important that you complement the estate docs with this family governance and this framework and the structure. And then let's wrap up here by talking about charitable. We've been talking about charity. Let's talk through some of the different vehicles that are used in order to execute some of this charitable vision that is weaved into the family governance and the estate docs. I think the most common vehicle we see is what's called a donor advised fund. So I'd love for you to break that down. But I think before we even jump into that, it's important to note that donating cash is generally the worst thing you can donate to a charity, but by far entrepreneurs donate cash more than anything else because it's the simplest.
Yep.
But remember that when you donate anything to a charity, you get a deduction based off of the fair market value. So you want to generally donate highly appreciated assets. So for example, if I bought stock in Tesla and it's gone up a lot, if I donate Tesla stock, I don't get a deduction on my tax return for what I bought it at, but what for the fair market value was at the date of contribution. But then on top of that, I don't have to sell the Tesla stock and pay the capital gain taxes on the growth, because when I donate it to a donor advised fund or to a charity, they sell it. They don't have to pay any taxes. They're a tax-free entity. So I think it's really important to first ground us all in that generally it kind of drives me crazy. Giving cash is generally the worst thing you can give to a charity.
Absolutely. And one just side note, and we don't have to go into great detail on this, but if you're getting QBI, qualified business income deduction, through your business, then you have a higher tax bracket in your personal world if you make a lot of money than in your business. So rather than giving to the charity from the business, which entrepreneurs often do, in that case, you're often better taking a distribution and then making the personal contribution to charity. A donor advised fund. Donor advised fund is very simple, easy to set up. You could set one up in a couple of days at any of the major brokerage houses, Fidelity, Schwab, wherever you want to set it up. Very low cost. And the great thing about a donor advised fund, because it's simple, low cost, but it works where you get to put in the money in the year you need the deduction most, and you can put in Tesla stock if you want to amplify that or leverage that by not paying the capital gains taxes. But you get the deduction the year you put the money into the donor advised fund, but then you get to decide when you actually give that to a charity. So for example, if you give $100,000 to a charity every year, that's your charitable gifts, and you had an enormous year and you've got an extra $1 million, you could put the $1 million into the donor advised fund, which would fund the next 10 years of your charitable contributions, but get the deduction in the year where you're in the highest tax bracket all across the board. That's the magic of a DAF or a donor advised fund. And many of our entrepreneurs utilize that. You can also name it the Bryce Keffeler Family Foundation. Name anything you want. You can have your kids take it over at some point. That can be used for what I talked about, just a few seconds ago. If you want to once a year get together and decide how money should come out of the DAF and what charity it should fund. And hopefully you get your kids to do that after you're gone so that they continue that tradition, pass it on to their kids, and have all the grandkids get together once a year and decide where the money goes.
Yep, I love it. All right, let's talk through some charitable trusts. I love using the metaphor of the apple tree here when we were talking about charitable lead trusts and charitable remainder trusts. And the metaphor here is that you, as the entrepreneur, plant this tree. So there's a tree, and this tree produces fruit every single year. Let's call it apples. And what you get to decide, and it depends on whether you want to do a charitable lead trust or a charitable remainder trust, is I either get to harvest the apples or I get to keep the tree. Which of these do you want? And so in a charitable remainder trust, the way that it works is that you are harvesting the apples every single year, which represents cash flow. So you plant the tree, you put money in this trust, you get a tax deduction, and then every single year you get cash flow or distributions from this trust, which are the apples. But when you pass away, you leave the tree in the garden for future generations, for future charities. So that's the metaphor there for the charitable remainder trust.
Yeah, that's good. And charitable remainder trust, like you were talking about with Tesla stock, that works best if you put in an appreciated asset, because when it sells, there's no capital gain. So then you have a higher dollar amount or a bigger apple tree, creating more apples than if you had to pay the taxes and you'd have a smaller apple tree afterwards.
Yep, and we saw this with a client who had a private equity deal. It was an 8-figure deal. Put some shares in a charitable remainder trust ahead of the liquidity event. And so then what happens is they sell the shares. Then that's a tax-free transaction. So the charitable remainder trust is the one that sells it, pays no taxes. And then there's income that gets spit out every single year to the entrepreneur. And then the remainder amount is going to go to a donor advised fund that will be controlled by the entrepreneur's kids. Now, when that money comes out every single year to the entrepreneur, that is taxable, so that you do pay your income taxes, but you spread it out over a long period of time, and you essentially are creating your own pension plan. Is the way that you're doing that.
Yeah, cool.
So that's a CRT, charitable remainder trust. The charitable lead trust is the inverse. That's essentially saying that, hey, I'll give the apples every single year to a charity of my choice or to my donor advised fund. But then after this term, whether it's 10 years or 20 years, whatever amount is remaining here, which is the tree, is going to go back to future generations, or it's going to come back to me individually. So the charitable lead trust is very, very powerful in low interest rate environments because you can get a huge tax deduction up front. You get to give money to charity every single year for 10 or 20 years, and then whatever amount is left there at the end of that term comes back to you. And we saw this was very popular in 2020, 2021, when interest rates, the Section 7520 rate was super low, around 2-3%. You could get 8%, 10% in your different investments. And if the IRS's rate was only 3%, again, anything above that amount would compound and be coming back to you at the end of the term. So charitable lead trusts were super important or super valuable in those low interest rate environments.
Yeah, and that one thing about the CLTs is you can do those post-exit.
Yep.
You can put cash into a CLT often is what people put in there. So that is one of the after sale strategies that can work in the year of sale.
Yeah, and working with an entrepreneur right now, they do tithing of 10% every single year. They're in the year of a liquidity event right now, and so they're going to be putting about $5 million into a charitable lead trust. That's going to be the tithing gift this year. Now that $5 million isn't going to go to charity right away. It's going to be a 20-year term. So over 20 years, that money is going to get distributed out. But that was important because the church actually could not handle a $5 million gift up front because their operating budget isn't big enough that it would actually kind of ruin the church. They would probably spend a little bit too much money and not be smart with it.
Yeah.
So it was actually very intentional that the church, there's a very specific church that's going to be the beneficiary here, but they're going to get that money over 20 years. So they can now build this into their planning if they have a consistent cash flow coming in over the next 20 years, but it's not a $5 million check up front, which would probably encourage them to, like I said, not be great fiduciaries with their capital.
Yeah. And then there's family foundations, which now you're talking about almost where you want to operate a charity, you want to provide services, and there's some deduction limits with a family foundation. They're more expensive, they're more complicated. However, if you wanted family members to actually work in the family foundation, you can pay them W-2 wages and all those kinds of things. That's something that you really have to be committed to services and to running a business. It's like running a business, having a family foundation if you do it right.
Yep, got to file the 990s. It's all public. All the financials are public, so there's no hiding behind any of that kind of stuff. But it does give you a lot of flexibility and to employ some of your family members.
Yeah.
Well, we covered a lot of ground here. Transferring your wealth and values, basic estate docs, all the way to advanced charitable planning. I think the big takeaway here from me, and I would say that my view on estate planning and wealth transfer planning has changed a lot since being a dad and being a father. Before that, as a single person or even just being married, I had basic docs, but it was morally just in case I run into a tree or I get paralyzed. Hey, you can make decisions. You can take all my money. I don't really care. But as a father now, it's very important to me of understanding, most critically, guardianship. Like we talked about, who do I want to raise my kids and underneath what kind of rules do I want them to hopefully be set up for success with, but also then my money, who gets what, when, and why, and then crafting incentive language within my trust. So I'm incentivizing the behaviors, the entrepreneurship, the education, the different behaviors that I want. That's really been what's gotten me really glued in on this topic.
Yeah, I think it's also an area that needs to be addressed. Is I know a lot of single entrepreneurs very successful and they think they don't need the basic documents, and they do, because especially there's no spouse, there's no obvious person to make financial decisions. There's no living will to talk about how you want to be cared for if you were in a really bad situation. Everyone needs basic documents. I agree. Once you have kids, it changes the game. I mean, everybody cares more when they have kids because now you start to see all these little people who depend on you, and you want them to have a good future and you want them to appreciate things, and you don't want all your work just to disappear because you didn't plan appropriately. So I think that's a normal thing for people.
Yep. Awesome. All right. We'll see you back here for Chapter 5.
Sounds good.
Thanks for listening to the Make Rich Real podcast, where million-dollar businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Dew Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performances for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.